Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor. I'm talking to you from the borough of Queens, and this is the first day of February in 2022. We do want to thank all of you for listening to the show, making it one of the more popular shows in the Voice of America Business Channel. Also, I'd like to encourage you to send along whatever comments you have about this show to questionsfortaylor@gmail.com. And we do need to thank our sponsors. They make this show economically viable. Novo Resources, El Oro Resources, Hannon Metals, Irving Resources, Lion One Metals, SK Mining Corp., Firefox Gold, and Timberline Resources are this week's sponsors. I've titled today's show Pathological Capitalism, American Style. Lynn Alden, Michael Oliver, and Quentin Henning join me this week. America is supposed to be the leader of the capitalist world, but Lynn Alden's January 2022 newsletter titled The Capital Sponge provides some hints as to why American capitalism has moved far away from the true capitalist model to something more akin to fascism. And Lynn points out that in recent years, the U.S. has attracted an amazing amount of global capital, far in excess of its relative economic strength as measured by GDP. So that is, according to Lynn, and I think very logically, she concludes that can lead to some big risks for investors in the equity markets right now. What happens if foreign capital, if massive amounts of something like $17 trillion of foreign money decides for one reason or another to move out of the U.S.? What happens to the markets when that happens, when that takes place, if and when it does, as Alistair McLeod has been predicting? How might that impact America's financial markets? How might that affect the various sectors? Might there be some sectors that would be more attractive and fare better in an environment in a bear market than some others? And we'll talk to Lynn about that. What about some of the foreign markets that aren't as overvalued as the U.S. seems to be at this point in time? In the second segment of today's show, right after our first commercial break, Quentin Henning will be joining me to provide an update on Irving Resources. And more than most companies that I follow in my newsletter, as well as other sponsors to this show, Irving, which is exploring for high-grade epithermal gold and silver deposits in Japan, has been negatively impacted by COVID. But now that the company is getting back on track with its exploration activities, Quentin will provide an update on Irving's plans and prospects for 2022. And yes, it's according to Quentin, a discovery that they just talked about in December is indeed a game changer. So we'll ask Quentin about that once he comes on with us in a few minutes from now after first commercial break. But right now, I'm happy to tell you that Michael Oliver is with me, and it's really good to have him with us. It's Momentum and Structural Analysis is the newsletter, and it's olivermsa.com to check in on Michael and to sign up for his letter. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
Always good to have you with us. On January 27th, you noted that based on your momentum and structural analytical work, you did not want to see gold crack below 1795, I think was your precise number, any day. And sure enough, it was only a day or two afterwards that it did crack that number, causing you to warn your subscribers this past weekend that there's still perhaps some downside risk here. What can you tell us now about your thoughts?
I think if there's any downside risk, it's brief. It could be sharp. I'm tending to think that the risk is maybe a bit less than I first assumed. What we broke last week was fairly minor intermediate term to short-term momentum factors, not big stuff. But let's shift to silver first. MSA's approach has been, before defining full green light again for the monetary metals, gold and silver, we wanted to see both of them clear certain hurdles. And in November, gold cleared the hurdle, but silver did not. And silver did not do it precisely within pennies of the number we specified. So we knew our numbers were good, and those numbers adjusted down for this quarter. And sure enough, in January, there was a rally that also went up to our new lower adjusted number, breakout number, and stopped short. As if it knew the number. Okay, so we know that our structures above on silver, looking at momentum now, not the price charts, are set for upside. We're confident of that, and they're massive. They look like once you clear them, silver could bolt back to the upper end of the range for the last few years, meaning the upper 20s, $30 quickly. but we got to cross the hurdle. They haven't done it yet. So we have a mixed picture in the monetary metals. But in the meantime, if you look at a price chart of silver, go back a couple years, you'll see that every low that we've made since the 2020 summer high, which was like $30, has been $22 or slightly below. 21 and a half maybe. Okay, there's like 4 times silver in the last year and a half has dropped down to 22 or 21 and a half. Never touched 21, but kept coming down to this floor that, pardon me, any idiot could see with a ruler and a crayon on a price chart. And so when you look at the price chart, you say, oh my gosh, there's a floor there. If they break it, it's all going to collapse. Okay? But when you look at the momentum charts, it's a totally opposite picture. You have a breakout ceiling just above you. Now, when I get debates like that between what price looks like, and everybody can see it, which looks, oh my gosh, there's a floor. If we break it, we're going down. And when I look at momentum, it says, no, you got a launch pad to go up. The debate is usually won by momentum. However, there's always the risk, and it's not necessarily bad, that you go down and stomp out what all the price chart guys can see. Namely, let's get down to $21 silver and blow that floor and see what happens. Our suspicion is if you put a stinger on the downside in silver, and we're only talking $1 or so from where we are right now, okay? You go down, tag that number, blow out all these obvious price lows going back a year and a half, and nothing happens, and you flip back up, we think you'll explode. But we think there's the risk that you might do that. Which have the downside raid first. We're watching with that in mind. Now, we're not looking for a disaster. We're just looking for a bear trap, is what you can call it.
Yeah.
And meanwhile, we're getting the same kind of picture out of the stock market the other way, where we're getting a mixed picture there, where, for instance, the end of January, NASDAQ 100 by our metrics is broken. Annual momentum broke. Big scale. Okay. S&P did not. Literally in the last 3 hours of the month, we had a number we didn't want to see the market close below, and it rallied and closed above it. So it avoided it. Okay. I don't think it's going to continue to avoid it, but it did. So you have a mixed picture there. And, when you go around the world and look at other major stock indices, Europe did the same thing that S&P did. It got below stuff and got back above it on the close of the month. China and Japan didn't. They broke below us. You get a mixed picture. So we have the same thing going on in the stock markets of the world that we have in the monetary metals, only with different directions. We think the stock markets are topping, and we're waiting on silver to give us the full green light. But in the process, like you mentioned, we did issue a cautionary note that maybe there'll be some kind of short-term downside raid here left within, in the gold and silver markets. We don't think it's a trending situation. We think it's a stinger if it occurs. So that's all right. Sort of to define what we meant.
All right, and Michael, you paid some attention to the dollar-gold relationship in your weekend missive. Would you like to comment on that? I mean, there doesn't seem to be any correlation.
A very lengthy report on the dollar to show a couple things. One, its correlation to gold. Yeah, maybe over the 50-year period, the dollar has come down in huge slabs. People don't pay attention to that. They just look at the last few months. We think that the recovery the dollar has had, which has been trivial on a percentage basis over the last year. We were down under 90 on the dollar index, and we got up to 97 here this month. We don't trust that rally. We think it's failing. So we think the dollar is about to head back down again. But the close correlation, inverse correlation between dollar and gold is not good. It doesn't really exist. And we showed that because if you went back to 2015 when gold made its low, just, $1,046, it doubled, okay? Got up to 2070 in a matter of, 5 years?
Right.
Less than 5 years. What did the dollar do? Nothing. It was sideways during that 5-year period, either side of the mid-90s on the dollar index. So the dollar index is not a good thing to be looking at on a day-to-day, week-to-week basis. It really isn't. It's not, broadly speaking, yes, the dollar will decay as gold goes up, so will the yen, so will the euro. They all decay. Okay? That's what they do. But any attempt to use it as a trading indicator is not a good idea.
One more thing here before I let you go. Lynn Alden is going to be our guest in the second half of today's show, and she's talking about the overvaluation of U.S. equities relative to other markets around the world.
Yep.
Something like 62% of all of the equity market valuations in the world is here in the U.S., despite the fact that we only have 28% of the global GDP, something like that. Those are her numbers.
That's where the dollar's important.
So here's my question for you.
Yeah.
Now, I know you watch global markets. Do you see any equity markets anywhere in the world that might be attractive now relative to the U.S. dollar market, or would you stay away from
none of the major
everything?
markets? No, I think they're all going to go in unison. The issue will be which goes down more, and I think the U.S. will go down more. Why? It's a bubble.
Mm-hmm.
It's a bubble beyond. China can turn down, but it didn't have a bubble. Okay, they weren't printed into outer space like we were. And I think the issue on the foreign investors is this. One of the factors they look at, but U.S. investors don't, is the currency in which they had to buy it. The dollar.
Mm-hmm. Yeah.
If the dollar suddenly drops, as we think it's about to, even if it drops 5 or 6, 7%, you can take that off their position.
Mm-hmm.
I mean, that hurts them. The S&P could stand still, but if they lose in dollar valuation, then that's a factor for them. So the dollar, in fact, could be important to those foreign investors. And to the extent that they're heavily weighted in the U.S. market, which is definitely the case, if they start to run, partly because they're being provoked by a weak dollar, that could help exacerbate the downside in the U.S. market relative to other markets. Yeah,
there's something like $17 trillion of foreign money invested in the U.S., and so Lynn will be addressing that, and what are the reasons why did that huge accumulation take place? She'll be talking about that. She'll also be talking about some of the things that could cause a reversal, and I would just think that would be one of them. If the dollar starts losing value and you're looking at it from some other foreigner's perspective, from their currency, and you say, oh my gosh, I'm really getting hosed here. I mean, it might not be a slow sort of an exodus. It could be a rapid thing, and I think I don't know.
I think it could be, very much,
Yeah. My engineer says I got a minute or two left. What about uranium markets, oil, gas, some of those things, commodities in general?
We still suspect there's a stinger in the tail in natural gas on the upside. It made a high short of $6.50 late last year. It dropped back under 4. And right now we're toying either side of 5. Okay. We still suspect technically that we could get up to maybe $9. Which, of course, for U.S. market is a big deal, considering it was a couple bucks a year and a half ago. Okay,
right.
But so we sort of like it on a percentage basis. Oil still looks like it's going to go up. It's in the high 80s. It could easily approach 100. Before it runs into next trouble. Uranium is holding. It's in a congestion zone. It's not a liquid market. The futures exist, but only enough to get a daily price, basically. They're in the mid-40s, and it's basically a coil for the last 4 or 5 months where it's holding its ground, but it's not gaining. We suspect there could be more upside there, too, along with the other energy sources. The energy is definitely still positive as far as we're concerned, and energy-related stocks, therefore.
Okay. Very good. Well, thank you, Michael. Thank you for the update on these key markets. Always valuable to have you with us, and I know one of our more popular guests, and you're always welcome. So thank you so much for being with us once again.